Today, we will talk about loan commitments. A loan commitment is an agreement by a commercial bank or other financial institution to lend a business or individual a specified sum of money. For example, when you apply for a mortgage to buy a house, the bank makes a commitment to lend you the money needed for the purchase. Financial institutions make loan commitments based on the borrower's creditworthiness and, in the case of a secured commitment, on the value of some form of collateral. For instance, if you apply for a car loan and use the car as collateral, the bank may offer you a loan commitment based on the value of the car. Borrowers can then use the funds made available under the loan commitment, up to the agreed-upon limit. A secured commitment is typically based on the borrower's creditworthiness and has some form of collateral backing it. For example, when you take out a home equity line of credit, the equity in your home is used as collateral. Because the credit limit is typically based on the value of the secured asset, the credit limit is often higher for a secured loan commitment than for an unsecured one. A loan that doesn't have any collateral backing it is primarily based on the borrower's creditworthiness. For example, when you apply for an unsecured credit card, the bank makes a commitment to lend you money based solely on your creditworthiness. However, because no collateral is backing the debt, the interest rate may be higher than on a secured loan commitment. Open-end loan commitments are flexible and can be useful for paying unexpected short-term debt obligations or covering financial emergencies. However, the downside of a secured loan commitment is that borrowers who take out too much money and are unable to repay the loan may have to forfeit their collateral, such as their home. Unsecured commitments have a higher interest rate, which makes borrowing more expensive. Here are 4 key takeaways. 1. A loan commitment is an agreement by a commercial bank or other financial institution to lend a business or individual a specified sum of money. 2. Loan commitments are useful for consumers looking to buy a home or businesses planning to make a major purchase. 3. The loan can take the form of a single lump sum or a line of credit that the borrower can draw upon as needed, up to a predetermined limit. 4. Loan commitments can be either secured or unsecured. A secured commitment is typically based on the borrower's creditworthiness and has some form of collateral backing it, whereas an unsecured commitment is solely based on the borrower's creditworthiness. It has no collateral backing it. Hope this would help. Thanks for watching.